Hi, what's up, everybody? I thought to myself, if you want to learn how to invest, it only makes sense to learn from the best at investing. So, like Warren Buffett, who's arguably the very best of all time. But then, wouldn't it also follow that you would want to learn from who taught Warren Buffett or Warren Buffett's mentors? In this instance, it's Benjamin Graham. Benjamin Graham was a professor at Columbia University that Warren Buffett studied under. And they grew together over time, and Warren Buffett and Benjamin Graham became great friends and they learned to invest together. But after Ben Graham died, Warren Buffett, with the help of Charlie Munger, really developed his career in investing. Now, what's really fascinating is on the Columbia University website, you can find Benjamin Graham's lectures. There are 10 that are listed here, and I decided that it might be fun to go over one of these lectures and probably walk through what I think of these lectures or maybe try to simplify some of it in my own interpretations. So I think that's what we're going to do today. In the description, I have a link to this website here so you can read all the lectures. Or if you want me to go over all these lectures in the future, definitely let me know in the comment section. But I'm just going to go over the first one now. Also in the description is a link to the StreamYard in case you want to join our lobby here, maybe ask questions, whatever. But I'm just going to jump right into it. So this is the lecture. It's got 9 pages to it. And it almost seems as if it was printed, like scanned from a PDF. Some of the words are kind of weirdly like translated almost. So I'm gonna do my best to kind of walk through those. And I'm not going to read through everything. It's just going to be my highlights and kind of tear apart everything that I think you need to know without having to read everything. So he starts off this lecture by saying that the enrollment has increased largely in short term, or short time, I should say. And it's because he's been so successful and he's got such a reputation at this point. And I believe this lecture was in 1946. It might say somewhere at the top. I don't really remember. Okay, so September 1946 to February 1947 is when these lectures were taught. So he said he's becoming popular. The classes are getting larger. And while it's great and he's flattered, it also leaves him unable to kind of have one-on-one with people. So that's kind of a disadvantage, and that's all that's saying right here. The subject of his course is securities analysis. He said that it's pretty much updating the work he did in security analysis. So if you like that book, this is probably going to be a great lecture for you. Then he starts by saying, what is security analysis? He says there's really 3 components to it. There's analyzing a security, there's having a margin of safety, and then the relationship of the analyst to the security market, which I kind of interpret as like the human psychology portion of it. Sorry, this is why I film everything ahead of time and then give you the edited version. I'm not queen when it comes to being live. But anyway, he says these are the techniques of security analysis, are really the components. He says really analysts they act as investigators. And this is something that I said Lee Lewis said in the past. If you watched Lee Lewis' 2006 Columbia lecture, Lee Lewis said that the job of the investor is really investigative journalism. So it's kind of cool to see that even years later, Lee Lewis is mirroring things that Benjamin Graham has said. But anyway, he says, we find ourselves almost acting as a mixture of market experts and security experts. So what he's saying is, not only does he feel like he's analyzing a security, finding out what the business is actually worth, but he's also trying to figure out the market sentiment. And he says he hoped that over the years, he'd see less of the market sentiment part and more of what the business is doing and more of the security analyst. But he says as time went on, he found that nothing really changed. You kind of have to be a little bit of both. So that's what I'll say right here. Analysts have recently been acting in Wall Street pretty much as they always have. That is to say, with one eye on the balance sheet and one on the income account. I'm sorry, one on the balance sheet and the income account and the other on the stock ticker. So that's what he's saying there. Now, it's funny because Warren Buffett, as we know him today, I suspect is really only looking at the security portion of it. I don't think he really cares about the market sentiment too much. He really focuses on the business itself. And I think Ben Graham really did too. But that's left to your interpretation. This paragraph I really didn't like. And it's kind of maybe one of the reasons why I haven't liked the Ben Franklin biography. And it could just be a sign of the times. So I feel like you can just ignore this paragraph altogether. But it says the correct attitude of the security analysis is toward the stock market might well be that of a man towards his wife. He shouldn't pay too much attention to what the lady says, but he can't afford to ignore it entirely. But as we know from Buffett, Buffett's a huge women's rights activist. So it is awesome to see that Buffett moved on, and the Times did too, although we're not there completely. But um, I I think it's cool to see how Buffett moved on past his mentor, and that's the only reason why I read that too. But let's get on to more of what Benjamin Graham thought about investing. So I'm going to read this full thing for you. He said, first, with regard to continuity. So he said there's really two principles that you need to focus on as an investor: continuity and selectivity. So he says, with continuity, and he'll explain it. The extraordinary thing about the securities market, if you judge it over long periods of years, is the fact that it does not go off in tangents permanently, but it remains in continuous orbit. When I say that it doesn't go off on tangents, I mean the simple point that after the stock market goes up a great deal, it not only comes down a great deal, but it comes down to levels we've previously been accustomed to. Thus, we never found the stock market as a whole going off into new areas and staying there permanently, because there has been a permanent change in basic conditions. I think you would expected such a new departure in stock prices. For the last 30 years, the period of time that I've watched the securities market, we have had two world wars, we've had a tremendous boom, a tremendous deflation, and now the atomic age is on us. Thus, you might well assume that the security market could really have been permanently transformed at one time or another. So past records might not have been useful in judging future values. So I brought up a website for you here that kind of shows you what happened between 1930 and 1955. I kind of wish it went further back, but this is all I have for you right here. And I think it does a good job. So you have the bank panic of 1931 after the 1929 stock market crash. Then you have the New Deal was established, World War II starts, Japan attacks Pearl Harbor, World War II ends, Korea War starts, and the Korean War ends. And like I said, there are tons of other things that happened before, like World War One. But he said those events are so traumatic, you would think that why would we use past performance to have any indication to us of what's going to happen in the future? Because you would think that it would be so transformative. And what are the chances that something like that is going to happen again? But Benjamin Graham actually says he does believe the past is an indication of what can happen in the future. I don't agree with him, but we'll just keep going, and I'll keep explaining things as we go on. So what he says here is, in sum, therefore, you can take the previous high levels, if you wish, as a measure of a danger point in the stock market for investors. And I think you'll find that past experience would bear you out using this as a practical guide. Thus, if you look at the chart of the Dow Jones Industrial Average, which I'll bring for you in a second, you can see there has never been a time at which price level has broken out once and for all in a permanent way from its past area of fluctuations. And that's what he has been trying to explain. So I'm going to bring to you, let's see here. I think this is a good indication. So what he's saying here is people were often left to project what's going to happen in the future based on what's happened in the short term. So let's say this portion right here, 1914, I'll say, up to 1917, was straight line up. And actually, I think by the way you're looking at me in the camera, I was like this way, right? Straight line up. So people in 1917 were like, wow, look at us in this forward momentum. Momentum's going to drive us up, but that hasn't happened. Ben Graham said that, it bounces down, and then people down here would project downward again and say, oh my God, we're just going to keep going down. But then, things came back up. And he said, at this point in time, we really broke out of this up, down, up, down, up, down, but it didn't stay that way. There was no new precedence that was set. It came roaring back down. And the pundits who believed at this time that it was going to keep falling down were corrected again by the fact that it bounces around in this funnel. Now, I told you that this course was taken in 1946 to 1947-ish. So right, let's see if I can pull it up. I can't really just hone in on it, but we'll say around here is right where Benjamin Graham was teaching his course. So you can see what he's talking about. There's the high, the low, the high, the low, high, the low, high, the low. So Benjamin Graham says it bounces around this point. So if you ever get to a high point, this is a good indication that it's going to come crashing down. But as we can see, that is not what happened. And this is what made Buffett so phenomenal is while Buffett was taking Benjamin Graham's course, Benjamin Graham said, no, it's not time for you to invest. You should keep waiting, because Benjamin Graham was doing technical analysis. Essentially, he said that there's going to be the time to crash, as it always does. But Warren Buffett didn't see it that way. He looked more at the fundamentals of the companies and stayed on the security analysis side. And then he was investing, and he did really well for himself. Yeah, I think that's pretty much it. Is the difference between projecting what's been in the short term versus Benjamin Graham looked it out on a longer term instead of bounced around this part. But again, it wasn't really the right analysis to provide, because you would have missed out on this, right? So yeah, let's keep going and just see what he says in this next paragraph. He says, another way of illustrating this principle of continuity, and that's what he means by continuity. I would substitute it by momentum. He really says he's trying to look for patterns, essentially. And he says some people are like momentum driven, but he's looking at momentum driven on a longer scale, and he sees it bounces around. Essentially, he's just got a longer frame of time than most Wall Street pundits, is kind of how I see it. But he says you look at the long-term earnings of the Dow Jones. We have figures here running back to 1915, which is more than 30 years. And he said that the earnings fluctuated between $10, $22, and back down, but they bounced around $10 essentially for the greater part of 30 years. So I don't have Dow Jones earnings since 1915, but I do have it from 1929 to I guess I have it to 2016, but 1947 is when he's taking a class. But yeah, you can see it bounced around this $10 mark, just like he said. And if you pull up the S&P 500, the data is pulled from Robert Shiller's information. You can find it on Robert Shiller's website, but this is a little easier to see. This is January 1st, 1900. The real earnings were about 15. And as we scroll every month, we see it's 15, 16, 17. And then we get to the point right before 1929 where it hits a high, I think almost 30. See, it's like it keeps going up to 20, but down to 16, 17, 15. But now we're really going to start to get to speculation. And we have around 31 right before 1929. I guess that's 1920. So we have 10 years to go. But it did crash right there. And then it recovers back to 15ish range. So this is what Ben Graham was looking at. He just sees it goes up and down. And this, most people would suspect for it to grow over time is what he's saying, because they want to see the momentum. Or if they're in periods where it's declining, for it to decline. But he says it bounces around. And it goes against traditional wisdom. Was he right? No, but I mean, he was right to observe this, but was he right about projecting it being correct in the future? No. So we'll keep going. So the next thing I highlighted says, what the commenters mean, as evident from their actual arguments, is that if you buy securities which apparently have good earnings prospects, then you will benefit market-wise. Whereas if you buy the others, you won't. So the key word here is prospects. So what he's saying is Wall Street pundits and analysts were obsessed with trying to find companies that had good earnings prospects. So not good earnings, but good earnings prospects. So this is the areas of speculation. So these were people that got really excited about companies, thinking that they were going to grow in infinitum and that they were going to grow at exponential rates and kind of meet the demand of what return they wanted to see. So I read this at first and I said, good earnings, like what are you talking about? But it's this prospects word that is really important here. So he says history shows this to be a very plausible idea, because you're right. If earnings do grow like they're supposed to grow, then you'd be really well off. But it can be extremely misleading. One of the easiest ways to illustrate this is by taking two securities here in the Dow Jones average, National Distillers and United Aircraft. Now, I would like to point out that this is called sampling bias, or maybe survivorship bias, and it could be taken with a grain of salt. Essentially, what the sampling bias is he's giving us an example of two companies. but there are thousands, tens of thousands of companies. So what if only these two examples support his evidence, but the remaining tens of thousands would suggest otherwise? And that's called sampling bias. So take it with a grain of salt, and we'll actually address it later on. But so you have two companies, National Distillers and United Aircraft. National Distillers sold at lower average prices in 1940 and 1942 than 1935, 1939. So imagine this distillers company, which was a whiskey company, and whiskey was a more luxurious alcohol at the time. I don't know if it still is. I'm a toddler, I guess. I just don't drink. But anyway, so in 1935, 1939, the stock was selling here. And in 1940, 1942, it dropped. No doubt there's a general feeling that the company's prospects were not good. So he's saying that everyone was feeling that they weren't going to grow as much as they had been in the past. In the same way, United Aircraft Company was a phenomenal prospect for growth because you had World War II at the time and aviation was flourishing in terms of speculation and how hyped people were about the aviation companies. But what he said about it is that had you invested in the two of them, National Distillers would have been much better an opportunity for you, despite the fact that United Aircraft had this huge prospect for growth. So nothing entirely there, except for people's best wishes for growth to be there. So what he said is, I grouped stocks together to prove this point into three categories. He said the first was a group that contains stocks said to be speculative because their prices were high. So let me give you an example of one today. So picture Microsoft. Microsoft is a wonderful company, but it sells for a high price to earnings ratio. So in a price to book ratio, however you want to measure it, it is not undervalued. We'll say that. So let's just say their price was high. Could this be a speculative company? So he's trying to really define what speculative means. So then he takes the second category. And these ones are determined to be speculative because of their irregular record. So imagine companies that aren't cyclical, but have high earnings, low earnings, low earnings, high earnings, high earnings, low earnings. And it's really hard to predict. So it's just an irregular record. Then you have a third set of companies that fit the criteria for his security analysis book, that you can measure them as being cheap on a quantitative standpoint. So how did they perform? So Group A said was companies like General Electric, Coca-Cola, and Johns Manville. So these are like the FANGs, the Facebook, Apple, Alphabet, Netflix, and Google of their time, essentially. Their combined price at the end of 1938 was $281, and recent low, it was $303.50. I'm guessing it's a 3. That's, like I said, it didn't scan properly, I'm guessing, and nobody edited this. And I say that because he said it advanced 8%. So he said this group, high-flying names, quality names, grew at 8%. And then you have the second group, which had the irregular record, said that it went from 124 to 150, an advance of 20%. And then you have, and I'm assuming these are total returns, which is just take how much you ended with minus how much you started with to get a profit, and then divide it by what you started with. Then you have the third category, which is the attractive security analysis, and they went up 190%, which is pretty remarkable. But like I said before, him pulling out little bits of stocks could be a sampling bias, right? And I said that in my little note right here, but he goes on and addresses that, and I thought that was awesome. He says, of course, these performances may just be a coincidence. You can't prove a principle by one or two examples, but I think it's a reasonably good illustration of the results, which you should get on average by using investment tests of merit. So essentially, he's done this work numerous times, and this is what he finds to be true. So I don't like that per se, because I don't, it doesn't give me the same information he's looked at. But what it gives me is an idea to go and do the research myself, if I were taking this lecture at the same time. So I would say take it with a grain of salt and then go do the work yourself. But what you'll find in his instance is that this is correct. And I I actually assume this to be true because value investors do best, essentially. So then he goes on to say that in his current time, IPO speculation was rampant. Sound familiar? So he gives a couple of examples. But before I give you a couple of examples, I've been recently reading Dan Wright, a book about Charlie Munger's life. And he said that if he were to teach a finance course, he would teach it so that way he would provide like 100 examples of companies that did really well or not so well. And it's really cool to see Benjamin Graham kind of follow. I don't want to say follow, but he did the same thing. Like we get so many examples of different companies. And in fact, I kind of scanned other lectures of his, and he kind of goes into more depth on more companies in some of those other lectures. We kind of started with an introductory, like what is investing, but you'll see. And I guess we talked about like market sentiment and stuff like this, which he turned out he wasn't correct on those. But what I find about Benjamin Graham is he's really good about analyzing the security itself. It's kind of like, to me, Seth Klarman. I don't think he's got a great idea. I won't say anything. I won't say anything. Anyway, moving on. Northern Engraving and Manufacturing Company was a stock that sold for $16 a share. And I'm guessing it was an IPO. It was valued at $4 million. It had about $1.5 million of tangible equity. And from 1936 to 1940, they averaged 21 cents a share. And then the 5 years ended 1945, they averaged 65 cents a share. So this is like during and before the World War. You can get a sense of what their earnings were. But in the 6 months leading up to their IPO, they had earnings per share of $127. Now, Ben Graham looks at this and he says, well, this engraving and manufacturing company probably did really well in the last 6 months because it benefited from a huge tailwind, or maybe some kind of environment led up to them being able to do so well. But we have such a huge history of them doing 21 cents or 65 cents a share that this last 6 months of $1.27 share could probably be ignored as an outlier. However, Wall Street disagreed. Wall Street said they're going to make $1.27 forever. And if they continue growing at this rate from going 21 cents to 65 cents to $1.27, that they'll be earning $2.54 in no time. And if you take $2.54 of the $16 they're at right now, then they're selling for a low price to earnings ratio. And Ben Graham says, nah, this is an outlier. We can't use the same growth rate. It's not going to be as good for you. And it turned out, I believe he was right. And this is what he's saying here. Extraordinary returns fooled people. And then he gives another example of the Taylorcraft Company, which is an airline manufacturing company. So he said, to begin, the company was selling for $3 million. And this is supposedly in a rather weak market. And what he means by that is people like the Wall Street analysts said, oh yeah, it would be selling for a lot more, but we're like in a weak market right now is kind of what he was getting at. So if you look, the working capital was only $103,000. So of that $3 million it was selling for, tangible working capital, I'm assuming tangible, was selling at $103,000. So what is that, 30 times book value, which is crazy. But then he says it gets worse because they have excess profits tax of $196,000, which is what they owe. That profits tax is what they owe. That doesn't get reflected in working capital because of this Section 722 claim. And he said, Ben Graham said, he's seen people use Section 722 before, but it's the only company he's seen to not include the excess profits tax on their current liabilities, which would have showed a working capital that was in the negatives. So he just goes on to say that there was also an advances payable, so more of a liability, current liability, of $130,000. So if you take the 103 minus almost 200,000 minus another 100,000, you get a working capital that's far in excess in the negatives for a company that's selling for $3 million. So he says the company is not worth that much. The company shows $2.3 million for stock and surplus. to add insult to injury, he just keeps going here. He says, it's stock in surplus, which is not as much as the market price of the stock. So essentially, they're saying it's more valuable than it's actually showing in the market. And then he says, there's plant and equipment that was marked up by $1.1 million that he says was arbitrary. He doesn't believe it to be the case. So just grossly overvalued as a company when you look at the fundamentals, he said. But then he said, let me give you I believe this one is a counterexample. You're going to have to wait until we see here. But in the meantime, the Curtiss-Wright company, which is also an aviation manufacturing company, has built its working capital from about 12 million to about 130 million. He doesn't give us a time range, I don't believe. But he just said there's modest growth here, and he believes it to be more accurate. It turns out this company is selling on the market for considerably less than 2/3 of its working capital. So this is one of those famous nets that Ben Graham is famous for. So then it goes on to talk more about the Curtiss-Wright company and the difference between United Aircraft and Curtiss-Wright and Taylorcraft and Curtiss-Wright. So when its working capital was about $18 a share, the market felt that it was unattractive. However, it advanced to $280 a share. We don't get a sense of when, but I think he said from 1922 it was $18 a share. At the valuation, he said was very cheap, and it advanced to $280 a share. I'm assuming by today. So now it's interesting to see Curtiss-Wright again after World War II being regarded as presumably a completely unattractive company. So essentially, people got really excited about aviation, thinking it was going to be huge in World War II. Everyone used airplanes. But then after World War II, everyone got disenchanted with aviation. Ben Graham said, even though I don't believe that the earnings growth will be as high as it was in World War II, because there was such a huge demand for it, he says, I don't think it's worth the low evaluation it is today. It's still a good earning company, especially when you compare it to the Taylorcraft company that we talked about earlier. And that's what he said here. So what he concluded on is in analyzing a company showing over the war period, it is quite important that you should do it by the balance sheet method, or at least use the balance sheet as a check. That is to say, you take the ending book value, subtract it by the beginning book value, add back all the dividends, and this should be how much the company earned within that period. So in the case of Curtiss-Wright, there is as much as a $44 million difference between the earnings shown in the reports and the earnings shown in comparison of the surplus and reserves at the beginning and the end of the period. So what he's saying is that they're even more valuable than they are today, because using his method, he says that they grow more than what the financial accounting reflects. And that's pretty much it for the first lecture. One thing that I wanted to impart on you guys that talks a little bit more about, this back and forth that we see with the Dow Jones and its earnings, and how people use momentum to kind of drive what they think is going to happen in the market versus what Ben Graham sees in the market. One thing Ben Graham is known for is this kind of chart right here. Imagine you have company 1, which is in the red, and company 2, which is in the black. Company 1, the Wall Street pundits at the time would have seen a downward trajectory and said, okay, well, these two companies are going to switch because this red one is going down and the black one's going up, and they would project it forward. This is what he determines as speculation. He said you had to be very careful with that because company 1 is a company with average earnings that's right here, and company 2 has average earnings right here. He said there is some truth to the momentum driven portion of it, but you should be very careful because this company has much more earnings than this one historically and on average. Maybe this was just a particular year in which it favored high headwinds, or maybe it's just a cyclical nature of the business where you're catching this one at a low point and this one at a high point. And this is what he was kind of telling people to look for in analyzing securities and then understanding how the market works too. It's the same concept, right? Because if you went from here to here, you would have projected this downward force instead of saying that, well, on average, it's here and it would be likely to see it come back here. Again, that's kind of technical by nature, and I was surprised how technical Ben Graham was. But yeah, so that's a lecture. Let me just jump in the StreamYard and see if anybody's on. Nope. Okay, so that's all I have for you. If you want to see more of these lectures and have me break them down for you, let me know in the comment section. But that's all, and see you next time. Awkward moment when I should have this ready to end the broadcast. But yeah, okay, bye.